But what about if you want to provide financing for your customers and you don't want to sell those loans? In other words, you want to keep those loans for yourself, let them play out over a 24-month, a 48-month term, and keep those profits for yourself. Hello everyone, I hope you're having an awesome day. So last week we talked about different types of purchasing programs, what to look out for as far as how can those purchasing programs fail, but also we touched on the idea that those purchasing programs can actually provide some needed cash flow if you get into a bind. But what about if you want to provide financing for your customers and you don't want to sell those loans? In other words, you want to keep those loans for yourself, let them play out over a 24-month, a 48-month term, and keep those profits for yourself. So today I want to kind of go over some things that will help you determine whether or not you can not only afford to finance your customers, but also should you have always been financing your customers. So let's get into some basic numbers that can help you determine whether or not this would be beneficial to not just your business, but your customers as well. So you decide you're going to keep your in-house loans, you're going to let them play out over time, opposed to selling them to a note buyer, which means that you're going to keep the margin that they would normally earn by purchasing your notes. And of course, if there's some interest on top of those loans, then you're going to get to keep the interest as well. So that's great because you can increase your profits, but you still have to design the program and design it in a way that you're going to minimize loss. So in the coming slides, what I want to do is I want to talk about some different features of these loan programs and kind of give you a general sense of what each one of these features' purpose is. And if not managed properly, you could still lose a lot of money on in-house loans, but you could also gain quite a bit if it is managed properly. So let's go through these slides, and I want to kind of cover the model that I'm going to base this after. And you can use the basic model that I'm getting ready to explain. But if you're not familiar with any part of this model, I do have a solution for you where you can make an in-house credit program pretty turnkey, and you can get going on it right away. I want to follow the three-quarter servicing model. And what the three-quarter servicing model is basically you have a group of loans. If you do the right things, you can get at least 3 out of 4 paying on a regular basis all the way through to the end of the term, whether it's a 2-year loan, a 4-year loan, however you set up the terms and conditions of the loan. But if you can get 3 out of 4 paying, that's essentially 75% recovery. And if let's say you have a program or a product that costs $4,000, at the end of the day, if you end up with $3,000, did you make a profit? If you did, then there's no reason why you shouldn't have an in-house credit program. Because when you have an in-house credit program, you not only capture like cash and income that your business has the potential of earning, but you also provide a service to the public because you give them access to your product or services when they normally wouldn't have the means to access that. So how do you get 75% recovery? Well, you have to kind of look at who you're financing and you have to understand the basics. So you're not going to get the prime credit customers, the people that have 750 or above credit scores. Those people can usually go to their bank or swipe a credit card and just pay you cash. The demographic that you're going for are people that have had some slow paying credit history and they're either looking to improve their credit or they're just simply looking for a way to pay for a product or service that they want or need. So let's look at the different type of customers that you would be interacting with. So you have a customer all the way to the left and they'll almost always pay you. So they've had some slow paying credit history and they appreciate the financing that you're offering because it gives them access to your goods or services. But also they may have a dual purpose. They may also want to use this credit to repair some older missteps with their credit. So they're pretty much committed to making the payments on time, completing the full financial obligation. Now on the opposite end of the spectrum, you could see over to the right, you have customers may never pay. So you're going to have a handful that maybe I would even go as far as to say they were never going to pay you at all. They had no intention of paying. And the reason why I talk about this particular customer is because you're going to have some of this. You're going to have some people that will not pay you a dime, and you're likely to have to take them all the way through the legal process in order to recover the balance that's owed to your business. Now, where you're going to do most of your work is the two in the middle, the ones that have the heading push and pull over the top of them. Those are basically identical. And those are people that they're going to slow pay once in a while, but you're going to have to put more effort into it. So they will fall behind. You'll have to pick up the phone or send them a letter. They don't normally fall more than 90 days past due, but you're going to have to put a little work into them to get them to make their monthly payment. That's not every month, but there are going to be some months during the life of the loan where you're definitely going to do some communication with these people. But we'll talk about some different things that you can do to kind of lower the amount of risk you have with this consumer base, and some things you could do to kind of add value to the investment that you're essentially making with your customers. So you want to encourage cosigners. As you can see, you got encourage cosigner, encourage cosigner, encourage cosigner here, and then you say need cosigner, and that's usually for the one that's going to give you some trouble. So once you get to this point where it says you need a cosigner, you need a down payment, pretty much you should do that with all of them. Also, down payments have multiple purposes, and we'll get into those in the following slides. Okay, so the first thing you need to do is get a better understanding of how your business would operate with an in-house credit program. So you're going to have to measure what's going on, and you're going to have to kind of predict what can happen in the future, depending on what kind of effort you put into it. So first of all, you want to pick like an accounting cycle. Now, if you're a business that has a sales team and you set monthly goals, I think a monthly measuring system is a pretty good system to kind of start with, at least until you become more familiar and get used to using your in-house credit program. So let's go with an accounting cycle of 30 days. And in that 30 days, of course, with any business, you're going to have some reoccurring expenses. In other words, try to find out what your hard cost is for your goods or services. So you want to know how much you're going to lay out every month to maintain your business. And the goal is to meet those reoccurring expenses and exceed them, at which point an in-house credit program would be a profitable venture for you. So let's go with 10 customers in any given month. That's kind of your break even, or it could be the point where you just jump into the black and you're making a profit. Now keep in mind, I understand incidentals can happen. This is just kind of a boilerplate kind of scenario here. So let's look at month one. You get 10 cash paying customers. If you do no financing, you've just done a regular month of business. But jump into month two, that's when you may want to look at financing. So instead of putting 10 cash paying customers in, you get 8 cash paying customers. So now this might be a month where you want to consider financing 2 people because your reoccurring expenses for that month are the same. You might as well go ahead and use that space. So in this particular scenario, it's not going to cost you anything to do financing, but it can be used to kind of fill in that gap from the 2 cash paying customers that you are missing. Now I've had clients that always ask for half of whatever the cost of their goods and services are as a down payment, which we'll get into in just a minute. And if you have 2 people and you get half from each, you pretty much have covered one of the customers that would have paid cash. So you take both down payments, you add them together, they equal 1 customer. So you've made up the loss of one of the 2 customers that you didn't experience like you did in the previous month. So now technically you're only financing 1 customer. Let's move on. We'll talk a little bit about cosigners and down payments and how those are useful. So cosigners, why do you want to get cosigners? Like most people say, well, then you have two people on the hook. But really, cosigners serve a much larger purpose than that. Like you can get down payment assistance from them. So if the primary buyer is having a hard time coming up with the down payment, sometimes the cosigners can help out with that. Because they're going to cosign on it. So of course, if they can lower the amount financed, that's going to be beneficial to them. It might even make it to where they can afford to be a cosigner. So for cosigners, the way they should look at it is if the buyer stops paying, can I afford to make that monthly payment? And if they can, then it's okay for them to cosign. If they can't afford that monthly payment, they probably shouldn't be a cosigner. But anyway, getting back on track, cosigners can help with down payments. Of course, they lower the risk. They're making an investment in not just your company, but they're making an investment in the person they're cosigning for, just with their signature. But cosigners can be instrumental in building customer loyalty, because if you do a good job for the person they cosigned for, and they're a family member, for example, they may even encourage another family member to do business with your business. So it's important, especially if you have cosigners, to do a lot to make sure that is a wonderful customer relationship, because these people are going to talk about you going forward. And then the last thing cosigners are helpful with is reducing costs. So of course, with reducing risk, they can help the buyer stay on track. If the buyer does run into a problem and a cosigner is a legitimate cosigner, meaning they can afford the payment, then you're not going to have to use human capital to reach out to them. You're not spending payroll dollars trying to get them back on track. So of course, that's going to reduce the cost of that. And then if they talk about you down the road, you could probably even save money on advertising, because like with any business, everyone's goal should be at some point during the life of the business to operate a lot with like referrals, instead of spending money on advertising, just trying to let everybody know you're there. So you can see cosigners aren't just good for guaranteeing the loan, they're good for most aspects of your customer relationships, because they are essentially another customer. But if they're cared for in the proper way, they can become a huge asset. Down payments. Of course, down payments are an amazing tool because you can generate cash flow for your business. It does lower risks because the consumer has some skin in the game, so they're more likely to follow through. It's a vote for your business because they're willing to put up some of their own money, so they're investing in your business, they're investing in themselves. And of course, if you do a good job and they follow through, then of course customer loyalty is one of the most important things that you could do for your business. And then, like the cosigners, over time you're going to be able to reduce cost quite a bit because of a job well done. Because remember, consumers and cosigners, they're going to talk about you, but you get to decide what they say. And all of these different aspects contained in the last two slides are very important, not just for your in-house credit program, but for your business in general. So what do you want to do once you're up and running, you have all your systems in place, then you have to think about the recovery cycle. You have to gain a good working knowledge of how things should play out. So you want to feed your portfolio, you want to measure what's happening, you want to continue to feed it, then you want to do some strategizing, and then of course you want to repeat that cycle. Because really the heading of this, strategy plus maintenance equals positive recovery. This is not something that you just want to create and then let it go, leave it on autopilot, because it will not take care of itself. You do have to consider things like, do you have the expertise to do this? So you're either going to hire trained staff, that's people that are good at this, or you're going to train your existing staff. But the most turnkey way to maybe approach this is just to outsource it with a company that has been doing it for many years, that knows what they're doing. And that will also allow you to kind of learn the ropes as you go through the program, because essentially you're watching them do it on a day-to-day basis and over a period of time. If you'd like to talk about this more, if you want to go into details about your business, your unique accounting cycles or customers, then give me a call, send me an email. I've been doing this for close to 30 years now, so there isn't much I haven't seen at some point. And believe me, different businesses have structured in-house financing several different ways. And I've seen them be extremely successful, but I've also seen them fail as well. But as always, be well, be safe, don't take any unnecessary risk, and I hope to talk with a lot of you soon. Take care. Hello, Sean Martin, Director of Business Engagement. So if you like this video, be sure to follow us on LinkedIn and YouTube. But don't forget to visit our website, check out the services we have to offer. Essentially, Partners Financial Services is a full-service accounts receivable management firm. So we specialize in billing, loan servicing, and debt collections. Some of the industries that we serve are the education industry, everything from a proprietary school all the way up to a college, university, higher educational level. Also banking, financial institutions, credit unions, and then a handful of miscellaneous industries that we do some debt collections for. So yeah, give us a call, send us an email, let us know what you have in mind, and we can see if our services can line up with your objectives and help you get in a better place than you are today.